Hey guys, my name is Fyzee and this channel is about finance and investing, and today we're going to be looking at the top US ETFs for Australian investors. Now this video was suggested by IK, so thank you so much for your comment. Before we begin, this video is not financial advice. I'm not a financial advisor. We're speaking in a very general sense only. Please do your own research. Let's get into the first ETF, which is ASX IVV. This is the iShares S&P 500 ETF, and guys, as the name suggests, this ETF tracks the S&P 500 index over in America. And this index is actually one of the most commonly quoted indexes in the world, so it's a good ETF to have a look at. And the reason why I like this one and why I personally invest in this ETF is the fact that, as you guys can see, the management fees are very minimal at 0.04%, so you're paying like $4 per $10,000 invested, so it's very little. Looking at some key facts for this ETF, we can see that the inception date is since May 2000, so it's been running for like 21 years, which is pretty good to see. And this ETF is domiciled in Australia, which means that when it comes to tax time, you won't need to complete a US tax form, which just makes the whole taxation journey a lot easier for us as Australians. And the benchmark index is of course the S&P 500 index, as we spoke about. The distribution frequency is quarterly, which means that you're going to be getting a quarterly dividend. This is pretty good because as Australians we normally get semi-annual dividends, so this just means that our cash flow is going to be improved just a little bit. But having a look at the holdings for this ETF, we can see that it's mostly made up of tech companies. You've got Apple, Microsoft, Amazon, Facebook, all the big giants of the tech world over in America. So the top 10 holdings of this ETF make up around 27% of this ETF's overall holdings, and we can see that 7 of these 10 companies are directly related to technology, as you guys can see. And companies like JP Morgan, Johnson & Johnson, and Berkshire Hathaway are 3 of the remaining companies that are not directly related to technology. Now, having a look at the sector breakdown, you guys can basically see what I've said before. The largest sector is 27%, which is based in IT because of the tech giants. Then you have healthcare, consumer discretionary, financials, and communication at somewhere around that 11 to 12 to 13% mark. Now let's say that you guys have a look at this technology sector and you think to yourselves, I want to invest more in technology. I like the way that Apple is trying to grow, Amazon is trying to grow, and I want my portfolio to have more of an allocation in this technology sector. Well, the next ETF we're going to look at is ASX NDQ. This is the BetaShares Nasdaq 100 ETF. And as we can see, this ETF tracks the Nasdaq 100 index over in America. And the great thing about this index is the fact that it tracks 100 of the largest non-financial companies over in America. And the main feature of this ETF is the fact that it is quite concentrated when it comes to technology. Since it's basically only tracking 100 companies, it is very technology heavy. Now, having a look at some quick facts for this ETF, we can see that the management costs are 0.48% per year. That means you'll be paying around $48 per $10,000 invested. The distribution frequency is semi-annually, so you're going to get a dividend twice a year. This is all pretty standard stuff. Now, I just want to talk a bit about the management fees of 0.48%. Now, this may seem quite high when you first look at it and when you first compare it to other ETFs on the market, especially the ETF that we just had a look at. But just keep in mind that since this ETF is quite technology heavy, this ETF has actually done pretty well over the last 10 years, as you guys can see if you have a look at the returns. And that's of course because tech has done quite well over the past couple of years. So when it comes to looking at ETFs, don't always just look at the fees, also look at the underlying companies, because ultimately these are going to be giving you the actual return. Now, having a look at the portfolio holdings, we can see that Apple, Microsoft, Amazon, these companies all have a weighting of just around that 11 to 10% mark, which is pretty huge. And you can see that 8 out of these 10 companies are directly related to technology. Now, if we compare these portfolio holdings and these allocations of these tech companies to the previous ETF that we just had a look at, you can roughly work out that the holdings for this ETF are roughly double of the previous ETF, which is pretty interesting because it's giving you that increased exposure. Now, having a look at the sector allocation for this ETF, we can see that IT is a massive 48% of this ETF, so it's basically half. And if we compare this to the previous ETF that we had a look at, technology was somewhere around that 27% mark, so it was kind of half of this. So depending on how comfortable you are when it comes to the tech sector, you can look at this ETF and the previous ETF as well. and whether or not you think technology is overvalued or undervalued, and you can kind of pick accordingly. And looking at some other items in the sector allocation, we can see that there is very little allocation towards stuff like communication, consumer, and healthcare. It is basically half of technology, and that just shows you how concentrated this ETF actually is. But let's say that you as an investor, let's say that you don't want too much allocation when it comes to technology and you want to take on more of a balanced approach when it comes to investing in the US market. Which ETF should you have a look at? Well, check out this ETF, which is ASX QUS. This ETF is the BetaShares S&P 500 equal weight ETF. Now, as the name suggests, when you buy this ETF, you're getting access to the S&P 500, but the twist in this ETF is the fact that each company is roughly equally weighted. So what does that mean? Basically, as you guys know, and as we've discussed, previously in those previous two ETFs, the US is quite heavily dominated when it comes to technology, and those mega cap companies can often cause huge volatility in the index because of their large movements. So this ETF basically tries to kind of smooth out those volatilities by reducing the concentration risk. So when all companies are weighted equally and technology has kind of a lower dominance, the concentration risk is automatically reduced. And having a look at some benefits of QUS, you guys can basically see that this just reinforces what I just said. And having an ETF like this also has the small potential of actually outperforming the S&P 500 index because it's rebalanced quite regularly. However, looking at this ETF's returns in practicality, we can see that the 5-year return is somewhere around 39%, and the 5-year return for IVV is around 100%. So far, QUS has not been able to beat the S&P 500 ETF. And that's mainly because the tech sector has done very well over the past 5 years. So why am I including this ETF in the first place? Well, because there's a lot of people out there that don't like the fact that the US is too dominated by technology, and they want to take more of a balanced approach when it comes to investing in the US market. Because if you really look at it, if you add up the market cap of all of these big tech companies, they literally make up a few trillion of the overall market. And if you add them all up and compare it to GDP of America, it actually makes up quite a sizable and surprising amount. And some people just want to balance out the risk even more. So this ETF is worth considering just because of that reason. Looking at some quick high-level facts for this ETF, we can see that the management costs are 0.29% per year, which is fairly low. Looking at the distribution frequency, it is semi-annually, which means that you'll get paid a dividend twice a year. And having a look at the portfolio holdings, this is where things get pretty interesting because you can see that we're not able to see some of the big tech companies here at all, except for like Facebook that we can see. And you can essentially see that each company has an equal weighting of 0.2% roughly. And if you open up the full list of this ETF's holdings, you can see that the big tech companies like Apple, Amazon, Tesla, these companies all have a weighting of roughly around that 0.2% mark. So each company has been given that equal weighting instead of the ridiculously high weighting that they have in other ETFs like the NDQ ETF or the IVV ETF. So as an investor, if you think that the US technology has been overvalued quite a lot, this ETF may be worth considering. And having a look at the sector allocation for this ETF, we can see that it's fairly evenly distributed between IT, industrials, financials. It is all somewhere between that 10 to 15% mark. And if you have a look at this pie chart, it is actually very, very evenly distributed. And this is mainly because of all those companies getting a roughly equal weighting. But let's say that as an investor, you wanted to invest in the US market, but you didn't want to invest in just the NASDAQ 100 or the S&P 500. Let's say that you as an investor, you wanted to invest in the entire US market. Well, the ETF we're going to look at is the Vanguard VTS ETF. This is the Vanguard US Total Market Shares Index ETF. And the unique thing about this ETF is the fact that this tracks nearly 100% of the entire US market. So it's very, very diversified to say the least. A lot more diversified than all the ETFs that we've looked at in this video. Now, personally for me, I don't invest in VTS. Instead, I prefer investing in IVV. but this is more of a personal preference. You can choose either one because the returns for both of these ETFs have been roughly the same. And either way you invest, you are going to be getting quite a diversified approach. It's just that VTS is going to be more diversified. Having a look at some high-level facts for this ETF, we can see that the fund size is $2 billion. It's domiciled in the US, so that means that when it comes to tax time, to avoid getting taxed more, you do need to fill out a form to make sure that you get taxed less. So just keep that in mind. And if you are confused about that, make sure that you do speak to an accountant just to be sure. The fund inception is since May 2009, so that means that we've got just over 1 decade worth of history, and the management fees for this ETF are a minuscule 0.03%, which I like to say is in true Vanguard fashion because they are super low, and this kind of reflects what Vanguard is actually about, because they're all about giving low cost access to retail investors and make things very accessible to them, so that's pretty good. And these fees are only slightly lower than the first ETF that we had a look at, because that ETF had fees of like 0.04%, so it's only a very tiny difference. Now, having a look at the number of holdings for this ETF, we can see that it's over 3,700, which is just huge if you really think about it. And as I said before, this ETF is a lot more diversified than the other ones that we had a look at. And the sector allocation for this ETF is more or less similar, because we can see that the highest weighting is in technology, then you have consumer, industrials, healthcare, so it's fairly similar. And when it comes to the holdings of these companies, we can see that it's more or less similar, except the big tech companies have a smaller weighting, so we're not going to go too much into each individual holding. And having a look at the distributions for this ETF, they pay out a dividend quarterly. But let's say that you as an investor want to invest in the US market, but you kind of want to get a magnified return on your investment, then you can have a look at the ETF, which is GGUS. This is the BetaShares geared US equity fund, and it's hedged as well. And the special thing about this ETF is in the name itself. It gives you geared exposure to the S&P 500, which means that BetaShares leverages this ETF for you to give you magnified returns, so you as an investor don't need to use debt on your end. So basically what I'm trying to say is that this ETF gives you the effect of leverage without actually using leverage yourself. So this makes it a bit less risky to you as an investor. Now, what that means for you guys in very, very simple terms is the fact that let's say that the S&P 500 goes up by 2% in one day. Theoretically speaking, this ETF should increase on that day by 4% because it's magnified by 2 times. And the reverse is true as well. If the S&P 500 falls by 3% in a single day, then this ETF should drop by 6% in that day. So it works both ways. It's kind of a double-edged sword. So this sort of ETF can give you those high returns, but it's at the expense of increased risk. Now, having a look at some quick facts for this ETF, we can see that the management fees are 0.8% per year, and these are the highest management fees in this whole video, and that's because BetaShares is taking on more risk by using debt themselves to magnify this ETF. So of course, if they are taking more risk, they have to be compensated for that, and they're going to be compensated by you, the investor, paying those high fees. Now, the distribution frequency is annual for this ETF, and the reason why I think it's so infrequent is the fact that this ETF is mostly designed for those short-term plays. So the people that actually buy this ETF aren't really looking to hold this ETF for the long term just to get those dividends. So for BetaShares, it doesn't make sense to kind of, send those dividends out quarterly or semi-annually. But this is just speculation on my end, and it might not even be true, but that's what I think anyway. But if you guys do have an answer, let me know. So the way that I personally look at it, this sort of ETF is mostly designed for those traders who are trying to take advantage of those short-term fluctuations and making a quick gain. But what I would tell you is that if you're new to investing and you're trying to invest in the US market, this ETF should not be your go-to investment because it is quite risky and quite volatile. Now, having a look at the gearing for this ETF, we can see that the gearing range is between 50 to 65%, and the current gearing ratio is around 51.9%. And the current gearing multiple is 2.08%. So that basically means that if the S&P 500 goes up by 1%, this ETF should theoretically go up by 2.08% in a single day, and vice versa if the S&P 500 was to fall as well. And lastly, having a look at the sector allocation, we can see that it's mostly similar to the other ETFs that we had a look at, and there's no real change here except the fact that this ETF is just geared. So these were the top 5 ETFs for you to have a look at. But as always, I am going to give you guys some bonus ETFs as well that I think you should look into as well. So let's get into it. So the first ETF we have is TQQQ. This is kind of like GGUS that we just had a look at, but this will give you 3x return instead of giving you the 2x return that we just spoke about of the Nasdaq 100 index, not the S&P 500 index. Now, as you guys might know, the Nasdaq 100 is much more volatile than the S&P 500, so that means that this ETF is a lot more riskier than GGUS. So in very general terms, if the Nasdaq 100 increases by 3% in a single day, this ETF will increase by 9%, and if the Nasdaq 100 falls by, let's say, 5%, this ETF will fall by 15% in a single day, and this has actually happened before many times in the past because the Nasdaq 100 is quite a volatile index. Now, this ETF is not listed on the ASX, instead it's on the Nasdaq, so you have to use something like Stake to buy this ETF. By the way, there's a referral link in description if you want a free American stock with Stake. Now, as you guys can see in this graph, this ETF increased quite ridiculously after the March sell-off. It's over 500%, and this is all due to leveraged returns over time, and it's mostly for short-term plays. This ETF is not designed for long-term holds because the management fee for this ETF is about 1%, which is pretty expensive. And the opposite of this ETF is SQQQ, as you guys can see, and this is basically the opposite version of TQQQ. So if the market falls by 5%, then this ETF should rise by 15%. And as you guys can see, historically, this ETF has been falling in value since it launched, and the return is literally like minus 99%. So this ETF is not for those long-term holds once again. It's only for those short-term plays, like we saw in the March sell-off when this ETF increased by quite a lot. But just keep in mind that if you do buy into ETFs like this, you're basically betting against the big companies in America, so you guys can see why it's not intended for those long-term holds. And the last bonus ETF we have is ASX UMAX. This is the BetaShares S&P 500 Yield Maximizer Fund. And this ETF basically tries to maximize the dividend yield from companies listed on the S&P 500. And the good thing is that the companies in America pay a quarterly dividend, so you'll be getting quarterly dividends from this ETF, which is pretty good for us Australians. Now guys, if you enjoyed this video, check out this one, which goes into the top 5 Vanguard ETFs for you to buy, or this video which talks about the top 5 BlackRock iShares ETFs. Both of these ETFs should diversify your portfolio even more. And guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Of America.